the jump in the prices we've seen was mainly driven by the geopolitical risk, which we've seen arising from the Russia, Ukraine, Israel, Hamas, and also from the so far unsuccessful discussion between Iran and the US. So that provides some support to the prices, even though OPEC has decided to continue with this higher production growth for July, the month of July. So there's some optimism, from the discussion between US and China and the de-escalation between US and China. But again, the large part of the strength in the prices were driven by this higher geopolitical risk we've seen last week. And let's not forget, there were also some unforeseen disruption in Canada from the wildfires.
Indeed. So, Sushant, before we move on from this, what should markets be looking out for from these talks today in London? And do you expect any kind of significant breakthrough? The optics here are important, but of course the substance will be very closely watched as well.
Well, I think the market is really looking forward for optimism, between U.S. and China's discussion, which is happening today. We expect the markets will, still remain uncertain about where the discussions will go, because they're definitely, coming from a very far apart position at the moment, although there is a 90-day pause between them. So we expect the markets to remain uncertain and weak, and also, both the countries know that they have to strike a deal because their own GDP growth will be impacted if they don't, strike a deal. So overall, we expect China's GDP growth to, go down to 4.3% compared to the government target of 5%. In the US, we are forecasting 1.5%, and we downgraded that from 2.3 percentage points. So both the countries know that there has to be a deal, but they're obviously coming from a very far apart position. So we expect that may take more time, than this discussion today. So overall, we expect global oil demand to remain weak. For this year, expecting around 0.9 million barrels per day of demand growth for this year, compared to 1.3 to 1.5 last year of growth.
Sushant, we keep hearing that demand is going to catch up. The question is when? What's your expectation?
Yeah, I think as I was saying, obviously, there are a lot of trade negotiations happening at the moment between U.S. and its trading partners, and we are already halfway through the 90-day pause which started in April. So I think there is obviously a lot still needs to be done, for the 90-day pause period. We still believe that the markets, will remain weak for this year. The global GDP growth will remain weak, and the rebalancing towards manufacturing, which we were expecting this year, is delayed. So overall, I was saying 0.9 million barrels per day of demand growth for this year, which is still weaker than past year of growth, and which will have an impact on the oil prices.
One of the other key issues influencing the price direction right now is just the weaker USD. To what extent would you say that's also helping to shape the curve right now?
Well, I think from a volatility perspective, yes, the dollar will have an impact on its own. But again, we have to just take out the fundamentals, right? At the moment, there's more than enough supply in the market, right? If you look at, the oil markets today, the non-OPEC supply growth is much, much more than the demand growth forecast. So I think the markets are oversupplied, and OPEC wants to produce more and more, right, throughout the next few months. So I think that will have a larger say on the oil prices than any movement in the US dollar. I would say the markets will remain weak and will be driven more by fundamentals. So we see a downward pressure on the price of the next few months.